Tony, I wanted to thank you and your staff for the attention to detail that went into my Roth conversion consideration. I know we had planned on pretty large conversions for this year and next before the laws change, but I'm very thankful we know exactly what we're getting into instead of trying to figure this out alone and getting blindsided by the tax ripple effect.
As our recent Tony in the Trenches reflects, the idea of a Roth conversion can, let me repeat, can have some huge merits and potential tax savings for that saver out there. And as Dave discussed here, we are very thankful that we were able to help him, and we appreciate his kind comments about our tax planning department that ran all of these calculations. Now, before I share the rippling effects of a Roth conversion, there are pros and cons to any financial decision, folks. Let me go over our concerns here and what Dave was concerned about. As you might know, by the end of 2025, the current tax laws, which are some of the lowest in history, will expire. This is a fact. Now, nobody knows what they're going to do, but assuming the worst case scenario, they could go through the roof. Assuming best case scenario, they don't do anything. Middle of the road, what most people think is they're going to go back to the 2017 laws. That's what the law currently says. When they expire, if Congress does nothing, they'll revert back to 2017 laws, which again mean higher taxes. So if you've got a 401k, IRA, TSP, if it's pre-tax, you could have a big problem. So that's why people are talking a lot about Roth conversions. Our job is to test the plan, make sure the conversion's right for you. Well, what are we testing for? Well, let's go through this. We call it the rippling effect, so to speak, of a Roth conversion. So again, don't rush out and do these until you see somebody like Tony Walker Financial. Let's just go through these line item by line item. The first thing is federal income taxes. Folks, you have to understand, if you take a large Roth conversion scenario, maybe you've got several $100,000 and you convert it to a Roth, all of that money has to go on your tax return, and there's a good chance it's going to throw you, I call it throwing you, throw you in a higher tax bracket. Next on the list, state income tax. People forget about this, but pretty much everything in the state of Kentucky and Indiana, that's our viewing audience, state of Kentucky has about a $31,000 exemption. Indiana has none. The majority of this money, we're just going to assume, is going to be taxed anywhere from 3 to 4%. So you got state taxes on top of it. Social Security taxation. People forget about this. Folks, you got to remember, this is included in income. It will affect your Social Security and more than likely cause extra taxes to Social Security. Modified adjusted gross income. Here's a chart. Why do we worry about that? Because it could affect your Medicare premium. So remember, the more income you make, Roth conversion is considered income, it's going to increase the Medicare premium Part B. Capital gains, there is effects on capital gains, although this is an ordinary income situation, but that throws you in a higher bracket. If you have other capital gains, it could actually tax those at a higher rate. RMDs, now it can have a good effect. This does not include RMDs. So if you're 73 or older and want to do a Roth conversion, the Roth conversion is not going to be applied to your RMDs, so there's really kind of double taxation. However, the good news is if you do the Roth conversions before or even after you start your RMDs, this will lower the calculation for future RMDs. And again, we can go over these details and more when we meet. Next, we have market conditions. You know, sometimes people recommend, and I've done this before, when the market's down or you've got assets that are down, that might be the best time to convert those to a Roth. Remember, if your assets are valued very high, maybe the stock market's up, and you convert those over, all of that's going to be taxable. Then if down the road the market drops back down, yeah, you got a tax-free Roth, but you also might have an account that's worth a lot less money. And lastly, remember the 5-year rule. So if you do convert money from a pre-tax to a Roth, remember you have to wait 5 years before you can touch that money. So all important considerations. And what I would say is if you're worried about future taxes and want to look at a Roth conversion, and if it's a possibility for you, happy to do that, no cost or obligation. Just log on to TonyWalkerFinancial.com, click on that Let's Get Started, or call us anytime at 877-499-9255.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.